Hi, my name is Catherine Palmer, Executive Director of Financial Risk Management at New South Wales Treasury. Today, I'm going to talk to you about how challenges posed by climate risk have the potential to result in financial risks. I'll cover some of the drivers that are already leading governments to respond to climate risk. Governments are potentially exposed to climate risk due to their role as primary managers of public assets, infrastructure and services, and land use. Recent events, such as the 2019-20 bushfire season and drought, have demonstrated the potential for disruption due to natural disasters, extreme weather events, and climate risk. Impacts from climate risk are driven not only by changes in natural hazard risk, but also by changes in socioeconomic and demographic factors. Financial impacts may include increased expenditure to repair or rebuild damaged property, lost income, or reduced asset value. There is also potential for insurance premiums to increase in areas that are deemed as high risk. Other impacts may include reduced productivity, reduced state revenue, or increased expenditure on required service delivery. In response to our already changing climate, international financial institutions, including credit rating agencies and central banks through the Network for Greening the Financial System, are increasingly considering climate risks as part of their long-term risk assessments. In the wake of the New South Wales bushfires in January 2020, Moody's published an investor note discussing that the long-term impact of climate hazards can impact on credit risk. Moody's noted that New South Wales' diverse economic base provides strong fiscal capacity to manage immediate climate hazards. However, the ratings agency expects New South Wales to face additional capital spending requirements for adapting to climate change and improving resilience to drought and bushfire risk. There have also been signals as to expectations on the public sector coming out of the Hutley opinion, which was updated in March 2019. The Hutley opinion was originally commissioned and released in 2016 and notes that directors who do not properly manage climate risk could be held liable for breaching their legal duty of care and diligence. The 2019 update highlighted that these expectations had increased and that there is a notable alignment in the positions of the Reserve Bank of Australia, RBA, Australian Securities and Investments Commission, ASIC, and the Australian Prudential Regulation Authority, APRA, regarding the potential economic significance of climate change. Given this increasing recognition of a legal duty to consider climate change, we're also seeing an increase in climate-related litigation, including here in Australia. The world's first legal claim concerning climate as a material risk to the sovereign bond market, O'Donnell versus the Commonwealth, was filed on 22 July 2020 in the Federal Court of Australia. This lawsuit is notable for two things. Firstly, that the claim has specifically named senior government officials, and, secondly, it is notable for its key claims, including that the Commonwealth Government has breached its duty of disclosure and has misled and deceived investors by not disclosing climate risks, and, as a result of the alleged disclosure breaches, Commonwealth officials failed to perform their duties to the requisite standard. The case also reflects growing market expectation for organisations to disclose the financial impact of climate-related risks and opportunities. Recommendations from the Task Force on Climate-Related Financial Disclosures, TCFD, an initiative of the Global Financial Stability Board, have been highly influential among investors, industry, and a range of other actors. Globally, the TCFD now has over 1,000 supporters headquartered in 55 countries, spanning the public and private sectors and including organisations such as corporations, national governments, government ministries, central banks, regulators, stock exchanges, and credit rating agencies. While there is no agreed standard for governments to follow regarding climate risk disclosure, state governments in Australia are increasingly referring to the TCFD to develop appropriate government risk management and disclosure. For example, through issuance of guidance to catchment management authorities in Victoria, exploration of disclosure policy and related capability building in Queensland, and the implementation of measures by Landcom in New South Wales, which enabled them to issue their first TCFD-aligned disclosure in 2020. Such disclosures will help ensure state governments are positioned to access the growing pool of capital flowing to the global and domestic sustainable finance market. Investors are increasingly looking to the sustainability strategy of issuers, including credible plans for how governments will meet their Paris Agreement commitments and demonstrate progress against net zero targets. So how might climate change impact the New South Wales economy? The New South Wales Economic Blueprint 2040 identified climate change as one of 5 global megatrends that will help shape the trajectory of New South Wales and the primary driver for negative impacts on our natural environment. One of the aspirations set out in the New South Wales Economic Blueprint 2040 is flexibility to deal with changing climate. It signals that a changing climate will mean the economy is increasingly likely to move to non-fossil fuel exports, including hydrogen. The blueprint also acknowledges that the actions of the Commonwealth Government and other jurisdictions will play critical roles in this space. Climate shocks, including extreme temperature events, bushfires, storms, droughts, floods and sea level rise, would likely impact critical infrastructure, the natural and built environment, and the health, well-being and livelihoods of communities in New South Wales. Climate risk is also monitored by New South Wales Treasury as a potential financial risk. In June 2020, the Reserve Bank of Australia, along with 66 other central banks from around the world, released new modelling suggesting that global GDP could fall by as much as 25% by the century's end due to the physical risks of climate change if little or no mitigating actions are taken. In 2020, Deloitte Access Economics has projected that unmitigated climate change could result in the reduction of the size of the Australian economy by 6.3% by 2070 and lead to the loss of jobs. The New South Wales State Government is leading in its consideration of climate risk to our economic and financial future. To better understand our exposure, New South Wales Treasury has also modelled potential economic impacts of climate change up to 2060 under different scenarios, and has also looked at modelling potential impacts of sea level rise, heat and to agricultural production in the absence of policy interventions, with likely increased direct and indirect costs being a likely outcome. Investor and community interest in this sector brings opportunities for state government to progress its sustainability agenda and to attract investment through consideration of sustainability criteria and objectives. An example of this is New South Wales Government's Sustainability Bond Program, which was established in 2018. It is the only program of its kind among federal and semi-government issuers in Australia. The proceeds raised through the program finance projects that deliver positive environmental and or social outcomes and align with and contribute towards the UN's Sustainable Development Goals. The program's inaugural $1.8 billion 10-year green bond was issued in 2018. In 2019, the program's first $1.8 billion sustainability bond was issued. And in late 2020, New South Wales issued an additional green bond, printing $1 billion in this particular bond. Each of these bonds were oversubscribed by investors. In March 2020, the New South Wales Government released the Net Zero Plan Stage 1, 2020 to 2030. By delivering on this plan, New South Wales is expected to create quite a number of jobs and attract significant investment over the next 10 years. New South Wales has also started renewable energy zones, such as those prioritised for the Central West, New England and South West regions in New South Wales. At the end of the day, climate risks should be managed like any other risk to help protect our state's economy, communities and natural environment. In helping embed climate risk into your agency's risk management practices, I encourage you to engage with your financial management team to ensure that climate-related financial risks are also being captured and appropriately managed. Thank you.